Is it okay? Shall I start?
Yes, sir, you can start, sir, please.
Okay. So, good evening, the erudite speaker for the day, Nikhil Patel ji. Very warm welcome to you for the day's deliberations. Good evening, all the members, and a warm welcome to all of you. And I wish this program should have been attended in thousands for the simple reason that it is an important aspect of audit of SMEs. SMEs, that is most important, small and medium enterprises, because more than 80% of the members in practice are dependent on or auditors of small and medium enterprises only. So taking the GDP portion and employment generation portion, it generates around 60% of the employment, the small and medium enterprises, and 40% to the contributes 40% to the GDP. Even there, the contribution of small and medium enterprises is very big, and we, majority of the small and medium practitioners, have to gear up ourselves to handle so many things now. So it is not possible for a single member to handle all the situations across the various legislations, be it Companies Act, be it GST, be it compliance and income tax filing, all these things, trusts, all these cases we'll be doing. But it is a big challenge for a single small and medium practitioner to do. So the institute also has recognized the importance of this, and it has come out with various avenues of networking amongst the members to see that collectively we perform our test functions to the expected levels without compromising in the quality. With this background, we have one of the senior most speakers from Mumbai, Nikhil Patel ji. A warm welcome once again, sir. I take the privilege of introducing the speaker before handing over the session to him. It's a 3-hour session. If at all there is a break that is required at the insistence of the speaker, we can think of that. And I, Mr. Pannaraj, is Vice Chairman of SIRC of ICAI, in the absence of Chairman Chinnamastan and Secretary Mr. Naresh Gelli, I am given the job of compiling this program and handling this program. Once again, a warm welcome, and to take up the profile of the speaker. CA Nikhil Patel sir is based in Mumbai, and he has completed his BCom from Mumbai University in Commerce and Economics, also holding degrees of LLB General from Mumbai University, and a fellow member of the CA and CS institutes, and he started his profession in 1985. 1985, I repeat. See the energy that he has at this age to devote his time for this alma mater, the institute, and enlightening the members. Practicing the area of accounting and auditing, direct tax and financial management and regulatory frameworks. Experienced in handling audit, taxation and corporate advisory of listed companies having turnover of 1 billion to 140 billion. The partner in Kapoor and Parekh Associates, Chartered Accountants, Mumbai, and the proprietor of Nikhil Patel and Associates, and associated with various charitable trusts and social organizations, Dharti Parivar Trust, AIM and for Seva, Vishweshwar Trust, member of the Bombay BCA, and also convener of Wild Carle CP Study Circle of WIRC from 2003 to 6, and is a member of Accounts and Auditing Committee of Bombay Chartered Accountants Society, Mumbai. With this, I hand over the proceedings to the erudite speaker. Over to you, sir.
Thank you, sir, for the kind words. Welcome to all the participants. I don't claim myself to be an expert on the areas of audit, but what I have learned over my practice of 35 years, that if we take certain precautions, then the chances of making an error during audit becomes less and less. So with that thing in mind, I'll be sharing my experience with you, and particularly important aspects of audit which we need to cover for the financial year 21-22. And basically we'll be concentrating on the audit of SMEs. So here we'll be excluding the listed companies also, because listed companies needs a lot of extra disclosure, extra attentions. So by and large we'll be concentrating on this. So my discussion I have divided into two parts. We discuss audit of SMEs. Basically, these are the companies which are covered under the Companies Act. So entities covered by the Companies Act 2013 and all other entities not covered by the Companies Act 2013. This is the two part I have divided, and other entity will cover first in my presentation, which is covering forming part A, and then in the part B we will cover specifically SMEs covered by the Companies Act. So let us start with part A, that is companies other than the entities other than the company. So when we say what could be the entities which are not covered by the Companies Act, so it could be trust, it could be society, partnership firm, proprietary firm, AOPs, it could be alternative investment fund, but again they take the form of either a trust, mostly by the trust. So these are the entities which will be covered. There could be even NGOs, that is or NPO, what we call it, a non-profit organization. If they are registered under the Companies Act, they are not forming part of this, then it will get governed by the Companies Act, part B of my presentation. So basically these are the entities which will be covering. Now when we do the audit of these entities, the question comes, what kind of a format of financial statement it should have. So these entities, if they are governed by some specific laws, and if those specific law has prescribed the format of a financial statement, then we have to follow that. For example, trust, especially in Maharashtra and Gujarat. In Maharashtra, there is a Maharashtra Public Charitable Trust Act. So if your trust is registered with them, under the act they have prescribed the format of income expenditure as well as the balance sheet. So you need to prepare your financial statements in that format. Similarly, societies in Maharashtra, Gujarat also, they have a separate Societies Act. It's a state subject. Similarly, in South India also, they, if it falls under the state subject and there are specific laws of the state, and if they prescribe the format, then follow that. If not, like proprietary and partnership, no specific format is prescribed under any law. So there we can use the format. And very recently, Institute has come out with a publication called Technical Guide on Financial Statement of Non-Corporate Entities. It's a June 2022 edition of ICAI. So we can refer to this. In this, they have given the format apart from what are the accounting standards applicable. So in some of my presentation, instead of describing all those things, I have given a reference of the page numbers which you should refer, and it will be circulated. This technical guide will be circulated to all the participants, which I have shared with the SIRC. So your format is either specified by the law if you are falling under that law, or else you follow these technical guides, and that will give you the format in which we have to prepare the financial statement. Now second issue comes, applicability of accounting standard. Now as we know, till few years back we had only one accounting standard, that was accounting standard prescribed by the ICAI only. Then it was a need of the hour to converge our accounting standard with the international accounting standards called IFRS. Instead of adopting IFRS, India has adopted a policy of converging with IFRS, and that is by way of Ind AS. So broadly, for other entities, either they are governed by the Ind AS or they are governed by the AS, accounting standard or Indian accounting standard. So, and secondly, if you fall under a Ind AS, we'll see who will fall under Ind AS, but the basic thing is, if you once fall into Ind AS for any reason, you will always have to follow Ind AS only for your life of the entity. So for example, let's say BLLP, it was a subsidiary of a listed company. Now listed companies, as we know, compulsorily they have to follow the Ind AS. So because of that, if we have also followed the Ind AS, then forever BLLP will continue to follow the Ind AS, even though let's say in financial year 21-22, or rather I have just given in this example, it was a subsidiary till 21st March 21. So 2021 financial statement also was Ind AS, and the current our topic of discussion financial year 21-22, BLLP will have to continue to prepare accounts by following Ind AS and not AS, just because it ceased to be the subsidiary. So it is such a in a way we can call it a contagious disease. Once we touch it, we acquire it and we can't get rid of it. So we'll have to follow the Ind AS only. That is one thing. Now applicability of Ind AS is basically all the, as of today, is all the listed entities except banks and insurance company. Few years back, NBFCs were given exemption, but now they are covered. So NBFC is covered under Ind AS. Then unlisted companies and NBFCs having a net worth of 250 crores or more in the previous year. So if in the financial year 2021, the entity has a turnover, but basically this is applicable to first corporate entities. Right now we are discussing non-corporate SSEs. But if non-corporate entity has any relation with corporate entity, which gets covered by the last one. So right now when we are discussing other entities, means other than corporate entities. But for that we also have to consider, assuming that our other entities is either a holding or subsidiary or joint venture or associate of any of the corporate entity, then we need to find out what is the accounting standard required to be followed by those corporate entities. So for example, that BLLP has a turnover of let's say only 10 lakhs. So obviously it is not covered under Ind AS. But suppose it becomes a subsidiary of a listed company having a turnover of only 50 lakhs. But being listed company, that H Limited will have to follow compulsorily Ind AS. Now BLLP being a subsidiary of H Limited, which is a listed company, will also have to apply the Ind AS. Now once having applied Ind AS, so if Ind AS is applied in 2021, for the financial year 21-22 also it will continue. Or for the first time this other entity gets into one of these category of holding, subsidiary, joint venture or associate of the listed companies, or unlisted company having a net worth of 250 crores and more, then they also will have to adopt the Ind AS for the purpose of consolidation. So for their standalone, they can continue to follow the AS, but for consolidation, their accounts needs to be converted into Ind AS so that it can be consolidated with the parent entity. Okay, so this clears for other entities. Again, there are two kind of accounting standards to be followed. First of all, financial statement format, either prescribed by the law they are governed. If not prescribed, follow the institute guidelines and the format prescribed in that. That is for financial statement. For accounting standards, find out if you have any link with corporate entities which is covered under the Companies Act, which could be liable for Ind AS. Then you being having a link with that, you also will get attached by that Ind AS. So your standalone account can continue as per the AS for income tax etc. purposes, but For consolidation purpose, it could be Ind AS. So there could be a dual, or you can adopt voluntarily Ind AS and then continue to be in Ind AS. Okay, so this clears the basic framework what we have to follow for the other entity. Now, if you are governed by the accounting standard and not by the Ind AS, then as we know, Institute has prescribed the accounting standards. Earlier, there used to be three levels of prescribed for the entities: level 1, level 2, and level 3. Now, during 21-22 financial, they have added level 4 entity also. So, where Ind AS is not applicable, then AS is automatically applicable. So, extent of AS applicability will depend whether the entity is level 1 entity, level 2 entity, level 3, or level 4. Now, level 1, and if the audit is a level 1 entity, then all accounting standards are applicable. There are some exemptions for 2, 3, and 4. In some cases, there are full exemption. In some cases, disclosure exemption, but measurement is always there. So now let us look at who is covered under what. Now level 1. Now in this, let us remember that these AS is applicable only to non-corporate entities. When we come to part B, I'll tell you, a lot of us have misconception that if private limited company falls under level 1, 2, 3, we apply the accounting standard prescribed by the institute. No, never. I'll tell you the reason why we should not when we come to the part B. So right now for non-corporate entity, throughout this part 1 discussion, it will be a non-corporate entity. If it is a corporate entity, this accounting standard will not be applicable. So non-corporate entity which falls in any one or more of the following category. So these are exclusive ones. Either you fall under 1, 2, and 3, you will govern by the accounting standards for the level 1. So which are the entities? The entities whose securities are listed or are in the process of listing on any stock exchange. But basically listing happens only for the corporate entities basically. So if you fall corporate, in any case you are not into the AS. You are not into the AS, you have to follow the exactly into the yes, you will not fall into this AS of level 1 to 3. You have to follow something differently. To that extent, there is a overlapping. Then banks. Normally banks are also, if they are a listed one, or by and large they are a corporate entity. So practically this is of no use. Then all entities engaged in the commercial, industrial, or business activities whose turnover exceeds rupees 250 crores in the previous year. So now we are referring to financial year 21-22. So if the auditee in the financial year 2021 has a turnover of 260 crores, yes, it will be called level 1 entity. Let's say it is a partnership firm and the turnover in financial year 2021 was 260 crores. So that partnership firm will fall under level 1 as far as financial year 21-22 is concerned, and it will be considered as level 1 entity, and all the accounting standard prescribed by the ICAI will be applicable to it. Then all entities engage in commercial industrial activity where their borrowing, including public deposit, is in excess of 50 crores at any time during the preceding accounting year. So these both the conditions are cumulative. So if you fall under any one of this, either, so let's say my turnover is only 20 crores, but my borrowing is 60 crores, then also I am a level 1 entity. If my borrowing is 0, but my turnover is 260 crores, then also I am a level 1 entity. And then if I am a holding or subsidiary entity of any entity which is a level 1, then also I am a level 1. So it's like if I have a connection with some entity which is a level 1, I will automatically fall into level 1. Right? Now let us see what are the further requirements for level 2. Now for level 2, earlier your turnovers were 250 crores. Here your turnover should be between 50 to 250 crores. and your borrowing which was exceeding 50 crores is now between 10 to 50 crores. So excess of 10 crores. So 10 crores, no. If 10 crore and 1 rupee, you will fall under this, and not in excess of 50 crores. So 10 crore 1 up to 50 crores will fall under level 2, and your turnover which is exceeds 50 crores. So if your turnover is exact 50 crores, then you don't fall under level 2, and up to 250 and exceeding, but not exceeding 250 crores. So up to 250 crores, but more than 50 crores, you will fall under this. And again, everywhere holding and subsidiary entity of level 2, even though it could be level 3 or level 4, it will be considered as level 2. Now let us see what's the requirement for level 3. Now here the turnover limit is 10 to 50 crores and the borrowing is 2 to 10 crores. So basically that limit of turnover and borrowing has been the guiding factor for level 1, 2 and 3. Now if you don't fall under any of this, then you are level 4. So level 4 is a residual category. If you are not level 1, not level 2, not level 3, you are a level 4. Now as far as level 1 is concerned, as I said, all the accounting standards are applicable. So there we have to be very careful. Normally when we do the audit of financial statement, let's say partnership firm or LLP, normally we ignore this requirement. So we simply prepare P&L, balance sheet, notes to accounts and everything, but we forgot to prepare cash flow. So if you are a level 1 entity, or earlier you were in any of the category, but in financial year 21-22 you have elevated yourself to level 1 category, then you have to prepare cash flow. So that's why I have highlighted that whenever this happens, ensure that you prepare a cash flow. Now we come to applicability of accounting standard to level 2, 3 and 4. As I said, at some level, some exemptions of accounting standard is given. At some level, standard is applicable, disclosure exemption is given. For example, AS 15 level 1, we disclose a lot of things, actuarial valuation, and that 2-page note for the actuarial valuation comes, what is the rate, attrition rate, these rate, and the movement and everything we give. But when you come to level 2, 3 and 4, level 2 has some exemption, 3 has some, 4 has total exemption, kind of a thing. And this is covered very much in detail in the technical guide on financial statement of non-corporate entities, June 22 edition of ICAI. There they have given a full table, what exemption, with what conditions. Some of them I have covered in my subsequent slide. See, like these are the things. The first thing is, if you are not under level 1 and you are in level 2, 3 and 4 and you want to claim those exemptions, partial exemption, etc., then you have to put in the notes to accounts that you are a level 2 or you are a level 3 entity. That's why you have opted for the exemptions you are entitled for, and accordingly disclosures have been done in these financial statements. So this disclosure notes is mandatory. Many times we follow the standards applicable to level 2, level 3, but we may forget to put this note. So this is very, very essential. We have to put this. It is also possible that last year we were in one level, now we have moved to second level. And because of that, some exemptions have gone more, some have gone down. So we must mention in this year we are in which level, and we have opted for those exemptions. So that is to be mentioned categorically. So another situation could arise that level 3 has, let's say, more exemption, level 2 has little less. FY 2021 you are in level 3, now you have elevated to level 2. So some exemption is gone. As we know, normally we give previous year figures along with the current year. But here, if in the earlier year you are governed by those exemptions, then you need not give the previous year figure. But you have to mention the fact that in the previous year, the entity was a level 3, hence certain disclosures not applicable to level 3 for the previous, so for the previous year figure, those disclosures are not made. So I mean, just to clarify the matter, if there were something which was not to be disclosed in level 3, now this year I have elevated to level 2 and I need to disclose that. So I'll do the disclosure only for the current year. With previous year, I will not write anything about the previous year. You can't write even a nil, but you don't write anything. Just give a current year figure and add a statement, a note saying that earlier you being in level 3, you were exempted from this disclosure. So it is possible that there might be some figure in the previous year. When we say some figure, it could be nil or any of the amount which is relevant or related to the or with reference to the current year disclosure. However, you are not going into the detail and rework and putting it, but you are simply stating the facts that you are not disclosing because last year you are not required. So you have not disclosed last year and you continue not to disclose. When you go to the next year, you will disclose 22, 23 and you will put 21, 22 figure as a previous year. So this clear? So as I said earlier, whichever accounting standard applicable to level 2, 3 or 4 which you are following, then you have to mention specifically. You can also mention that you have, if you have complied for all the accounting standard, there is no need to mention. Similarly, if you go from level 1 to level 2 or level 3, then also you have to mention that current year you are into level 2, so certain disclosure are not done. If you do not want to offer any exemption, that's your choice. Then you can follow all the standards and then you can disclose everything. Then there are, as I said, in AS 15 employee benefit related different some exemption is given, which is based on the number of employees for level 1, 2 and 3. So that you can opt for and accordingly you can apply it. So this clears part 1 for non-corporate assesses, and you can in detail refer to this technical guide on financial statement of non-corporate entities. This is the guidelines. Everybody can, I think everybody is able to read it. Financial statement of non-corporate entities. This is June 22 edition of the ICAI. So this needs to be followed. Now we come to the part B, audit of SME companies under the Companies Act. Now that audit of company has really become complicated. Unlike when I passed out in 85 and I started audit, it wasn't much complicated. There were no accounting standards also, no Ind AS, only one accounting standards. Then Companies Act had prescribed the Schedule 6 format of balance sheet, P&L, and then general instructions were there, those quantitative detail, etc., which is no more now. So we have to simply follow that. Now, when you go through this presentation, you will realize that nowadays it is complicated, and that's why any audit we start, we must do some checklist, preparative checklist, and then we should start the audit. So I have given in my presentation some checklist 1, 2, 3. You must prepare that first, and then you come to the conclusion that A is applicable, B is applicable or not applicable, C is applicable or not applicable. And once you go through that, you will realize that why it is so important to do this. And this can be done whenever our staff is little free during the month of December to March. We can do some preliminary things because a lot of things are based on the last year's figures. So when we have already finished the audit of 2021, then during 21-20, whenever we are free, from those we have to pick up the figures, fill up. We can prepare a checklist in an Excel sheet. We can tell our staff, audit staff, to fill it up and conclude it, because don't have that working in mind. Put it in black and white. so that if our staff has made any error, by looking at it, we'll come to know, no, this is wrong. You have, this is the figures and this conclusion is wrong. It needs to be changed so that error can be detected. Okay. Now let us go through this part B. So first thing, let us check it. Now that we are in 2070, from next year onwards, it will be applicable. So I'll just brush up, not applicable to 21, 22, but 22, 23 will be applicable. So you have to be very careful about this. Rotation of auditor. Now 5 years is gone. Those who have a cooling period of 5 years is over, maybe your old clients would like to come back to you. And thereafter, these are in brief, I put rotation is applicable to which kind of corporate entities. And if you are a proprietary firm, then you can be appointed only one block of 5 years. If you are a partnership firm, you can be appointed for 2 continuous block of 5 years each, and thereafter a cooling period of 5 years, and then thereafter you can be reappointed. But which entities are covered, I have already put into this. So this is for your ready reference. And I have also mentioned in the bold, rotation is not applicable to small company, which is defined under 285, and one person company defined under section 2 subsection 62 of the Companies Act. So this is the first check. This I have already discussed. Now checklist 2. When you do audit of any corporate entity, first have, now that you are, let's say you are going to do for 21, 22. So during 21, 22, with reference to that company, prepare the list of the holding companies, ultimate holding companies, if any. Now under the Companies Act, you can't have more than 2 layers, so it has become easy. Earlier, otherwise, it could there could be a chain of 10 companies, and then you find out the ultimate holding companies. Find out which are the associate companies, which are the joint venture companies. Find out, are you a subsidiary of something? You could be direct, step down subsidiaries, anything. So that list you have to prepare. And your accounting standard applicability will depend on 2 things. First, to accounting standard applicable to your entity, audit entity, on standalone basis. That is part 1. Then part 2, if you are associated in one or the another way with other corporate SSEs, either as a subsidiary or holding company, then you need to also check the accounting standard applicable to all those entities. And that can change applicability of accounting standard to you. So that's the reason that this exercise is a must. So let us prepare this and we'll see how this is useful as we go on with the audit. Now let us check if you are a corporate SSE now, because now let us be clear of throughout this discussion on part B, we refer only to the corporate entities which are covered under the Companies Act. Okay, so when I say word company, it means company which is registered under the Companies Act. Let it be a non-profit organization, section 8 companies, in old law section 25 companies, but still it is a corporate entity. Now for all corporate entities, accounting standard is applicable because of section 133 of the Companies Act 2013. This Companies Act prescribes that accounting standard, which accounting standard is applicable. Now that was the reason I was telling that if you are a company under the Companies Act, forget about level 1, 2, 3 of the, or rather 4, 1, 2, 3, 4 as prescribed by the institute, because you will never ever be governed by 1, 2, 3, 4 at all. You will be governed only by section 133. 133 prescribes only 2 types of accounting standard. One is Ind AS and one is AS. Now, Ind AS is applicable to all the listed entities as far as 21-22 is concerned. Unlisted companies and NBFCs with net worth of 250 crore or more in the preceding year. So if in 2021 you have exceeded this net worth, then for 21-22 financial year you have to apply Ind AS. So it will be a first time adoption of Ind AS. Or if you are a, now last requirement, holding subsidiary joint venture associate of above two categories. Now here it is important. For example, you are a private limited company having a turnover of just 5 lakhs, but you are a holding company of some entity which is carrying on the commercial activity and whose turnover, whose net worth has exceeded 250 crores in financial year 21. So because of that, your subsidiary, let us call it S1 Limited, for financial year 21-22 has to apply Ind AS. Now, because that subsidiary has to apply Ind AS, the holding company also has to apply Ind AS. Now in 2021 it was not Ind AS, but now 21-22 Ind AS. So you will be governed by the first time adoption standard of Ind AS. But your accounting standard applicability for 21-22 will be Ind AS and not the AS. So that was the reason why we had to do that checklist of all the associates, subsidiaries, joint ventures. If they all have, if any of them falls under that, even you might have to do that. Now, assuming that you are a private, like you are a subsidiary, you have a holding company whose net worth has gone beyond 250 crores, and that holding company has got transferred from AS to Ind AS in financial year 21-22. In that case also, your entity will become liable for Ind AS under the Companies Act, even on standalone basis. So don't be under me, don't be have that misconception that my turnover is, my net worth is less than 250, I'll follow AS, I'll prepare Ind AS for the consolidation. No, under the Companies Act, no. If you are other entity, you can have standalone AS and prepare Ind AS for the purpose of consolidation. But that exemption is not available for the corporate SSC because you are governed by the Companies Act section 133. And there it is very, very categorical that which accounting standard will apply. Ind AS will apply in 1, 2, and 3 cases. So if you get governed, you will be. Now, if you are a bank and insurance company as of today, Ind AS has not been applied. NBFCs have been covered last year. So now if you are an NBFC listed company, you are covered by Ind AS. If you are a non-listed NBFCs and your net worth has crossed 250 crores in the financial year 2021, you have to follow Ind AS in 21-22. So I think now this concept of Ind AS is clear. So for all the corporate SSs, first apply, are you governed under Ind AS? If you are not governed under Ind AS, then you can go to AS automatically. But if you fall under Ind AS, you have no option to opt for AS. But if you fall under AS, but you voluntarily want to apply, adopt Ind AS, that you can do it. But once you have adopted Ind AS, forever you will be Ind AS. That you have to remember. Like if you have touched that Ind AS by error also, then forever you have to follow Ind AS. Now, even after, even your net worth is more and then you go out of this criteria, still it will be Ind AS. So that has to be remembered. So Ind AS cannot follow AS. AS voluntary can follow the Ind AS. So here I am just giving an example. This is my old example. So you have got holding H1, H2, and H3. But basically we can't have more than 2 layers. So just pardon me. I haven't corrected this my presentation. But now here if we see one holding company. So H1 is the ultimate. Now we are here trying to find out applicability of accounting standard for ABC. So ABC is the ultimate holding company. H2 is a holding company of H1. Sorry, it's not ultimate holding company. ABC has one layer above H1. H2 is a holding company of H3 is the holding company of H2. Now H3 is governed by the Ind AS. So automatically ABC is also falling into Ind AS. Had it not been either a subsidiary, so H1 is a subsidiary of H2 and H2 is a subsidiary of H3. Now, if that relation was not there and H1 would have been this ABC, sorry, H1, okay, sorry, here we are not talking about ABC. Assuming ABC is governed by the AS, but it's a holding company, H1 is a holding and there is H1 as H2 is a holding of H1. So in that layer, because one of the holding company falls under Ind AS, automatically Ind AS is applicable to ABC. That's what I am trying to conclude. Now, further, what will happen? Because ultimate holding company falls under Ind AS, all the subsidiaries, all the associates, all the joint ventures will fall under Ind AS. So forget about ABC. All these entities will have to apply Ind AS. So this is just an example to clear what I discussed earlier as to whom Ind AS is applicable. Okay. Now, secondly, we have to understand what is the definition of SMC, and we have to find out the auditee whether it is a SMC or no. So SMC is an entity whose debt or securities are not listed. So if your debts or securities are listed, you cannot be SMC. Now under the Companies Act, there are two kind of entity, SMC and non-SMC. Now this is a different than a small and medium type what we try to figure out by way of a turnover. You know, here sometimes even otherwise than turnover, being a holding or subsidiary, you will be out of SMC. So even your turnover is 2 lakhs, still you will be non-SMC. We'll see that as it comes. But by technical terms is under the Companies Act, you divide or you find out whether your auditee is SMC or non-SMC. Now, who is not SMC is given here. So if you are in the process, if you are your equity or debt securities are not listed or are not in the process of listing, you could be SMC. So if you are in the process of listing, you are non-SMC. Then you should know bank, financial institution and insurance companies cannot be SMC. If your turnover exceeds 250 crore in the immediately preceding accounting year, you cannot be SMC. If your borrowing exceeds 50 crores anytime during the preceding accounting year, you cannot be SMC. And then if you are a holding or subsidiary of a company which is not SMC, even you cannot be SMC. Okay. Now, these are the criteria which is prescribed who are not SMC. Rest all are SMC. Very simple. So for your auditee company, you just find out, are you non-SMC? 1, 2, 3, 4. Now, if you fall in any one of these criteria, you will be non-SMC. So if you are not excluded from SMC, then you are SMC. So this definition is in a way a negative kind of thing, that if you are not 1, 2, 3, 4, 5, you are SMC. So you just find out 1, 2, 3 and 4. The fifth criteria is with relation to, you have to find out the status of your holding and subsidiaries. If any one of the holding or subsidiary is non-SMC, automatically the whole group will become non-SMC. Okay. So as far as this definition part of non-SMC is concerned, and if you are not SMC, if you are not non-SMC means you are SMC. Okay, it's a negative definition that you should not fall into this, then you will not be SMC. So if you don't fall into this, you are non-SMC. When you are non-SMC, you are automatically SMC. And this definition is cumulative. As I told you, if you fall under any one of this, then you are a non-SMC. Okay. Like an example I have said, if your turnover is less than 250 crores, but your borrowing is 55 crores, you are non-SMC. Or if your borrowing is less than, let's say, 5 crores only, but your turnover is 260 crores, still you are non-SMC. So you cannot be SMC. Now here there are something like, what do we say, listed? MCA has given a notification in January 21 and amended the definition of listed company. The definition under section 2 subsection 52 of the Companies Act 2013. Now post these amendments, companies whose debt instruments are listed shall be excluded from the definition of listed company. So it is quite possible that if you are a company and let's say you have come out with a NCD issue of 5 crores and you have got it listed because of liquidity purpose, so that more people will apply. So before this amendment, even you have listed your NCDs, you are a listed company. You have not listed your equity. If you have listed equity, for all purposes, you are non-SMC. But if you have listed your debt securities, then because of this definition, you will not be considered non-SMC under the listing requirement. So you will still have to look at your other criteria like your borrowing, your turnover. If because of that you become non-SMC, you will be non-SMC. And when listed means listing anywhere in the world. So if your debentures, let's say, are listed on London Stock Exchange, Luxembourg Stock Exchange, Singapore Stock Exchange, still you will be listed like equity. It's earlier there have been the cases where your equity shares are not listed in India, but they are listed on the Luxembourg or they are listed on the Singapore Stock Exchange. In that case, you are a listing company and you will be treated as non-SMC. Now it talks about debt instrument. So if you have issued a convertible, it will be treated as non-SMC. But only here the criteria is what happens if earlier, since it was not defined and this amendment has come on that particular date, if you are earlier listed, whether it is applicable or you should get listed after that, there is confusion, there is no clarity. But when we see the benefits, non-benefit of SMC, non-SMC, it is very less. So on a conservative basis, you treat that as non-SMC so that you don't do any non-compliance. As we go ahead, we'll discuss what is the benefit of SMC or non-SMC. There isn't much benefit being SMC. Again, the same date issue I discussed, just elaborated. Then also companies in the process of listing are excluded from the SMC. Then the issue comes, when do I say that I am in the process of listing? Because those who have experience of dealing with the companies which has gone into listing, they would realize that as per the today's requirement of SEBI listing requirements and SEBI's guidelines, if you want to list your securities, the first thing you have to do is you have to pass a board resolution and declare your intention that you want to go public. And as a series of steps, the first thing you have to do is you have to appoint the lead manager, you have to appoint the banker, you have to appoint the lawyer. Again, lawyer, two types: one lawyer in India, one lawyer for abroad. Then those merchant bankers. The moment you have passed this resolution in the board and appointed this, obviously it is clear that you have taken a step for getting yourself listed. Once this is done, then you start preparing your draft DRHP, we call it draft red herring prospectus. Then you file it, gets approved, some queries come, you make the amendments, file it. Once it gets approved, you get a from SEBI you get a license that now you can come out with an issue. But even after getting that, you may not come out with if the market condition is not good. But that doesn't mean that you continue to be SMC. The moment you have taken that step of going public, you will get out of the SMC criteria if you are falling into that. And you, from that day onwards, you have already started initiated your process of getting listed. So you will be treated as non-SMC. Okay, this should be very clear in your mind. Because the eventual process may take 1 year, 2 years, 3 years, 5 years, and I have practically seen a case since last 7 years. In one of the cases, they've got the card for public, but every time it has lapsed, then they refile it because they find every time they want to come out with market is not conducive, so they are not coming out with an issue. So for commercial reason, you may not get your company listed, but the process is initiated. Because of that, you are out of the SMC and you will be treated as non-SMC. That is very clear. Bank, financial institution, and insurance companies by definitions are not SMC. So today you have just registered you have floated a company for carrying on banking activity. Let's say your capital is only 5 lakhs, net worth everything is also, as such you meet all the requirement of SMC, but still from the day one you are non-SMC. No doubt for the banks, subsequently there are the criteria of equity capital, etc., which are much more. So automatically we'll go out of that. But irrespective of anything, the moment you are a bank, financial institution, or insurance companies, you are non-SMC. Then turnover criteria is there. Now here definition of turnover means your sales. So those fine tuning can come, like your turnover is, let's say in this case, so your turnover is 245 crores, but you have income from bank, FD, etc., of let's say 15 crores. So total income is 255. But as we had a guidance note on tax audit, etc., what is the definition of turnover? We have to borrow the same concept to find out whether we are our turnover exceeding 250 or no. So those fine tuning, those borderline examples I have given for your clarity. So there is that gap between a turnover and total income. So for example, if there is a let's say real estate company, so they have constructed flats and 50 flats are lying idle, not able to sell it, he rents it out. So for that it is a business income, part of the turnover. But if you are a manufacturing company and you have invested in flats as an investment and you rent out, it could form part of your other income, so it will be out of your turnover. So guidance note on division 1 to 3 also helps you in this manner. Then similarly, if you sell the plant and machinery, you have a capital gain. It's not turnover, it is other income. Now borrowing includes your fixed deposit also. So that has to be, we have normal notion borrowing is only from the bank. No, other than bank, if you have gone for a public deposit, so that is also borrowing. So that has to be added. And then accordingly, you have to find out whether you are SMC or not. So if you are non-SMC, you are not SMC. Simple. And that borrowing 50 crore criteria is your 50 crores magic, that line has been touched once in a year, and then at the end of the year you have become a debt free company. Let's say your debt is totally zero. Still, once you have touched that line of 50 crores, you are non-SMC. So daily you have to find out the balancing, if at all there are a lot of movements. So the movement during the year, if you have touched 50, means you are non-SMC. Now we have to do one more check, whether your audit is a small company. Because small companies have certain advantages. As we go along in the presentation, we'll find. So these are some of the checklists we must prepare. And this checklist will help you in concluding various things and make your audit easy. So under section 285, it is prescribed, definition is given what is small company, your paid up share capital. Earlier it was a different limit. Now for financial 21-22, it is a 2 crore. Turnover not exceeding 20 crore. But turnover is of the previous financial year. So I have specifically mentioned financial year 2021. But paid up capital for the current financial year, which is under your audit. So as of 31st March, you have to look at what is your paid up capital. So as a corollary, it can happen that my paid up capital was 2 crore and 5 lakhs. Then 6 lakhs of equity capital I bought back during the year. I did all the process. So by that, before the end of the year, I am falling less than 2 crore. Then I am still a small company. But you will not a small company even if you meet these two criteria, if you are a holding or subsidiary, and if you are section 8 company, even though your capital is only 5 lakhs and you're obviously no turnover, it's a donation and charity activities, but still you will not be considered a small company. And companies which is registered under the special act, like RBI is registered by the Act of Parliament. Similarly, LIC of India is created by Act of Parliament. SBI, even RBI. So this will not be a small company. So it has to be a small company under the Companies Act. These are created by the Act of the Parliament. Now I have seen that various chartered accountants in practice, they were all under the impression that if my private limited company, my turnover is XYZ, etc., etc., so they were talking about level 1, 2, 3, 4. Again, I am making it very clear. If you are a company under the Companies Act, forget about institute standards as far as level 1, 2, 3, 4 is concerned. You are not governed because you are a company under the Companies Act, and Companies Act has specifically prescribed 133 Ind AS. If you're not Ind AS, then you are AS. So if you're not Ind AS and voluntarily opted Ind AS, automatically you are AS. If you are in AS, then you have to decide either you are SMC or non-SMC, because accounting standards are prescribed by the Companies Act, not by the institute. However, the fact is they have taken all the accounting standard which is prescribed by the institute, and now the standard to be prescribed by NFRA, etc., they will be adopting that. But applicable accounting standards are under the income tax. So you will always find during the last 1 year, 2 year, if you go back, you will find that institute had come out with some amendment, and then in the next 3 or 4 months, there is amendment in the Companies Act, which amends the company's accounting, etc. rules and says that this accounting standard is modified by adding whatever those changes are done by the ICAI is brought into the Companies Act. But basically, you are governed by the Companies Act. That has to be very, very clear. So any audit you do under the Companies Act, forget about level 1, 2, 3. And during my earlier various presentation, when I've asked this question, most of them will say, no, we'll find out what is level 1, 2, and 3. At that time, 3. This year now, even a level 4. I says, don't do level 1, 2, 3, 4. You are not governed by that. You are governed only by the SMC and non-SMC. So my earlier slides are very important. You find out, are you non-SMC? Yes, then all the standards are applicable. If not, you are SMC, then hold on, what to do, I'll tell you. Okay, so this clears your doubts forever, and this imprint in your mind very, very properly, that when you do audit under the Companies Act, forget about level 1, 2, 3. Only 2 criteria: Ind AS, AS. In AS, only in AS there are no criteria. Ind AS applicable, all standards are applicable. AS under the Companies Act has given exemptions to something, so that's why they have divided companies into 2 parts, SMC and non-SMC. So that's all you have to find out. So those criteria given, which I said, if you have 1, 2, 3, 4, 5, you are not SMC. So find out you are not SMC means you are non-SMC. Yes, then you are non-SMC. But if you are not non-SMC, automatically you are SMC. So you just find out your auditee whether SMC or non-SMC. Clear? So that's what I'm putting in this slide. This company's accounting rule, SMC, non-SMC. Yes. Now, basically, only exemption to SMC is AS3. That is, cash flow is not applicable. Under the accounting standard, not applicable. Okay, this is still not a final statement of mine as far as AS3 is concerned. And AS17, segment reporting is not applicable. Non-SMC, all the accounting standard 1 to 29, few are withdrawn, so all are applicable. Okay. So now we'll come to another checklist. As I said in the earlier slide, for non-SMC, exemption under accounting standard is there for the cash flow. But let us see the definition of financial statement given under the Companies Act. That is 2 subsection 40. Says balance sheet, profit and loss, cash flow. Then statement of changes in equity, which is applicable to Ind AS, and all the explanatory note. Together, all these things is your financial statement. So now when you are doing audit of a company under the Companies Act, cash flow is part of your financial statement. Now, under the Companies Act, cash flow is not applicable to small company, 1-person company, dormant company, and private company, which is recognized as startup as per the notification of DIPP with effect from 13 June 17. So basically, for assuming that under AS, you being you being SMC, you have got exemption under exemption of not preparing cash flow. However, you don't fall under this exemption under section 240. So if you do not prepare the cash flow, that means you have followed the accounting standard, but you have not followed the Companies Act. So like in colleges, we used to learn in those things, there are a set. So for exemption, you have to fall for the exemption in both. If you fall under exemption in one group, but other group you don't fall, then if you have to comply, because you are supposed to comply with Companies Act as well as accounting standard. So if you get exemption under one, but you don't get exemption under second one, still you have to prepare that. So that means cash flow exemption is not available if you are not exempted under section 240 from the cash flow. So AS gives you exemption to SMC, but you also have to fall under exemption under 240. If you fall under exemption in both, then you don't prepare cash flow, that's fine. Okay. So I just explained this. Now, under the SMC, cash flow statement applicability. Suppose under SMC cash flow is applicable, but under the Companies Act it is not applicable. Now, if you want to, you have to follow both. So one say yes, another says no. So you have to prepare the cash flow. So the result is yes. If under SMC you don't have to prepare, but under the Companies Act section 240, it is applicable, then also you have to prepare the cash flow. Under both you have to prepare cash flow, then you have to prepare the cash flow. Only when you are exempted from cash flow under the accounting standard, that is SMC, as well as under the Companies Act, that financial statement definition of 2 subsection 40, if you get exemption under both, that cash flow is not required under the both, then only you don't prepare. Otherwise you have to prepare. So in a nutshell, what is left out? If we go back to our earlier slide, you had two exemptions, AS3 and AS17. Now out of this, because of section 2 subsection 40, you have to prepare the cash flow. So your one exemption is already gone. So only exemption is segment reporting. So I will urge all the S&P practitioners, then and this exercise, if you keep it every year, you have to keep on doing. I'll come to further complications also later on. But just for this definition purpose, if you're not preparing S&P, what is the exemption you get? Only segment reporting. Now, most of the small clients, SMC companies, normally will not have segment. And even if segment is there, the disclosure is not that great. So practically, I have come to the conclusion, best is to follow all the accounting standards. Don't go for exemptions, because these exemptions are no exemptions at all. Because to get this exemption, a lot of things you have to do, and if your audit staff is not proper and in the pressure, if you have not checked that properly, it is quite possible that cash flow was applicable and yet you have not done. So then FRRB will catch you. So as a practice, as a rule, you simply say that you don't have to do SMC, non-SMC. All accounting standards are applicable. Because for SMC, again, there are certain disclosure you have to make that companies and SMC, hence accounting standard applicable to SMC has been prescribed. This is one reason. Second reason is, if you are SMC in the year, let's say in the financial year 2021, you are non-SMC. Now in the financial year 21-22, you are SMC. Still you are non-SMC, because once you are SMC for one more year, you will be SMC. You have to be SMC for 2 continuous years. So for example, year 1 I was non-SMC, year 2 I am SMC. So because earlier I followed non-SMC, means applied all the accounting standard, in the next year automatically I have to apply all the accounting standard. Now when you come to year 3, I am again SMC. So if you are SMC for 2 continuous years, then you can switch over from non-SMC to SMC. But then what are the benefits? Still cash flow is applicable. What's the only exemption you get? A17, which is hardly anything. But to keep a track of this is more complicated. So for the ease of practice, I would urge all my professional brothers that you simply follow all the accounting standard if you fall under the Companies Act. For non-companies, there are some more benefits. So there you go level 1, 2, 3, etc., then do that additional exercise. Okay, so that clarifies this. Now, if you are under the Companies Act, we have earlier prepared one list of holdings, subsidiaries, etc., etc. And then we have to check whether our auditee company is a subsidiary or is a step down holding company kind of a thing. Because if you assuming that the audit has a subsidiary or even a joint venture or associate, then consolidated financial statement is mandatory because you are governed by the Companies Act. So that has to be prepared. So you have to find out. So that's why I'm saying case one, subsidiary no, associate no, consolidated finance statement is not applicable. Then case two, you have a subsidiary, you have an associate, but you don't have associate. No, because you have either a subsidiary, associate, or joint venture. You have no subsidiary, but you have associate and joint venture. Still, you have to do the consolidation. So that's what I've given. So if you have no, then only you don't have to do consolidation. So you don't have subsidiary, you don't have joint venture and associate, then you don't have to do consolidation. If yes, then you have to. And let me clear a certain misnomer. Now, subsidiary doesn't mean a subsidiary under the Companies Act. For example, we are doing audit of a corporate SSC, private limited company, is a partner in LLP, having a 60%. Automatically, it is a subsidiary. Anything more than 50 plus one voting right is a subsidiary. So as per accounting standard, there are two things. The moment you invest, up to 20%, you will fall under AS21 investment. It's a normal investment, AS13. The moment you hold 20 and little more, up to less than subsidiary, it will be investment in associates automatically. If you hold more than 20 and more, it is investment in associates. So it will fall under consolidation. That is AS21. And if it is a subsidiary, AS23. So if you hold 50% plus one share, automatically it is a subsidiary. So you need not hold 51%. Let's say capital is 10 crore. So you need not hold capital of 51 lakhs. You have hold 5 crore and one share. I mean, if it is of 10 each, 50 lakh shares, you hold 2,50,001 share, means you have a voting power more than rest of the shareholders. In that case, it becomes a subsidiary. This is as far as Companies Act is concerned. But under India's it is different. Practically, even with 30-35%, it could be a subsidiary. There, the accounting standard prescribes something else. So to that extent, there is a mismatch. So this is another thing, and that's why that first chart is very important. Do you have any holding company? Do you have any subsidiary company? That chart should be prepared immediately. Before the year end also, there are the movement. So find out if it is there, then find out whether you need to have CFS or no. Right? Let's go next. Then you have to now find out as far as 21-22 is concerned, you know Schedule 3 has been amended and extensively amended. That's not part of my presentation because it will take 1-2 days to discuss that, as well as Caro has a lot of changes. But you must understand that you have to apply division 1, 2, and 3. Now we'll fall under division 3. All NBFCs following Ind AS will have to prepare financial statement in a format and those disclosure as prescribed in division 3. Division 2 is applicable to the companies following Ind AS other than NBFCs, and obviously banking and insurance and Ind AS is not applicable, so it will not be applicable to them. And the rest of the things who are following AS will have to follow the instructions given in division 1 of Schedule 3. All the 3 divisions have been extensively amended for financial year 21-22. So please read that carefully. There are certain amendments where there is interpretative issues where we have to take the proper call. But this time you will have to put in a lot of efforts. A lot of notes will come. In your audit report also you'll have to refer to the disclosure. In the Caro, what you are mentioning, what is there in notes has to match. So a lot of those things have to be done. but that's not part of my discussion. But remember, Schedule 3 applicability like this and has to be applied with extensive amendment during the financial year 21-22. Yes. Now, I would just like to bring to the notice of all my friends the major change in Schedule 3, irrespective of Division 1 to 3, all the division, this is applicable. Because specifically with reference to SME, we may have a private limited company having a turnover of 5 lakh, 10 lakh, 50 lakh, and we are preparing financial statement, rounding up to the nearest rupee, and most of the times even with paisa. Now that is debarred. Remember that is debarred. You can no more do this. Put a full stop to this. Whatever you have done till financial year 2021, you have to give it a go by. Has to be mandatorily, compulsorily, you have to do the rounding up. Now that is what I mean. Because being S&P, most of them will have a turnover up to, not even turnover. Now the term used is total income. Now earlier when we were applying SMC, etc., that 250 crore turnover criteria was there. So even though my total income is 260 crores, my turnover is less than 250 and I am SMC, etc., etc. But here it is a turnover, total income. So whatever in your financial statement, income statement, you have a total of income. If that is up to 100 crores, means it is not 100 crore and 1 rupee, or means 101 crore or in the roundup. Then you have to do rounding up to the nearest hundreds, thousands, lakhs, or millions, and or decimal thereof. So compulsorily you have to do rounding up either to interest. So if you are currently following the rounding up to the rupees, then you know in Excel you get last 3 comma. So what you can do, convert the same comma into the thousand. Instead of comma, put a full stop, and then you can do. But you will have to do that. Further to that, whatever rounding up you follow, let's say you follow hundreds, then you have to follow this practice of disclosing figures in hundreds throughout the financial statements, your cash flow, all the notes to accounts. Here you give figures in thousands, and in the notes to account you say remuneration to managing director 13 lakhs. No, if it is 1,000, there also 1,000. If here you put it into hundreds, there also hundreds. If you put it in lakhs, there also lakhs. If you put it in millions, throughout that it will be in notes, all the figures will be in millions. So that is a big change. So two big changes: compulsory rounding up, and we have to follow whatever rounding up throughout the financial statements. I cannot follow somewhere in thousands, somewhere in millions, or lakhs, or hundreds. No. Whatever you have decided, you have to follow throughout, right? And if your turnover is more than 1,000 crores, then it has to be compulsorily rounding up is in lakhs. So you can't follow hundreds and thousands. Somebody said, no, I like thousands, I like hundreds. Sorry, if your client's total income, sorry, not turnover, total income is exceeding 100 crores, then rounding up has to be lakhs, millions, or crores, and decimal thereof. And again, this has to be followed throughout the financial statement. So same unit of measurement is to be applied across the financial statement. So the company cannot continue to disclose full figures. Remember this. Now, because this Schedule 3 is applied under the Companies Act, so it is applicable only to the corporate SSEs. So that's why I put one more caution. Not applicable to non-corporate SSEs. What we have discussed in part 1, you can continue to have actual figure rounding up to the hundreds or even thousands, lakhs, anything you can do. Okay, that is your choice. You can choose what you want to do for non-corporate entities. But corporate entities, this is mandatory. So what, I mean, we are now already in the month of June. Otherwise, earlier when staff is free, we could have told them कि last year figure previous year में डालो, उसको convert कर दो, whatever you decide, thousands वगैरह वगैरह. Be ready with that. Then in the current year figure, you put thousands, lakhs, whatever you want. So that half of your thing gets done. Okay, so this you have to keep it in mind, and this is mandatory. Earlier it was like a voluntary, but now this is mandatory. So that's the big change. Apart from so many further changes which has happened in Schedule 3. So this is the only I thought very important. So I have drawn your attention that this revised Schedule 3, this is very, very important and you must remember it. Then second thing, what we do now, audit report under the Companies Act, you can have a unmodified, you can have a unmodified with emphasis of matter, modified report that is qualified, you can have adverse, you can have disclaimer. You will have to go through our standard of auditing 700 series, 700, 701, 702, 705, etc. And as applicable, you will have to, the draft model report are given in those auditing standard, SA we call it, standard on auditing. So you can refer to that. So this is also one of the important aspect. So this is again, I mentioned. Yeah, now here, key audit matters currently is applicable only to the listed companies. Voluntarily, if you want to apply, so that can be done. Otherwise, key audit matter is extra, which will be applicable only to the listed company, irrespective of the turnover. Now, as we know, when the UDI and in 700, if you refer, they have given this format for ABC and company chartered accountants, and they have mentioned firm registration number. I have added ICAI. I'll discuss why I have added ICAI. Then name of the partner, Mr. ABC, membership number of the partner, place date, and now UDI and also we have to mention. I have seen many reports where they change the format. But I think when in the standard of auditing they prescribe the format, I feel we should adhere to that. Now I'll come to this, why I'm adding ICAI firm registration number. When this firm registration number came, particularly in Maharashtra, we have an act called Partnership Act. So all the partnership firms have to compulsorily get registered under the Maharashtra Partnership Act. So I have got one registration number from that. Now, when I say firm registration number, there is a confusion. Which one? I have got two registration number now. One from Maharashtra government and one our institute has given me a firm registration number. So that's the reason from the day one I am writing ICAI firm registration number, and slowly I found that some of the big four and many mid-sized companies are adopting this. So I'll just urge, give your independent thought and accordingly you can mention. But if you mention something differently, some member write here and then membership number on the top and some ulta sulta they write, don't do that. Follow this. So that's why I thought to put this slide. If you are following some different format, please don't follow this. Instead of ICAI, you want to write still firm registration number, no issue. If in the South India also in some of the state, if there is a state law which makes partnership firm mandatory registration, that means those SMPs will have those two registration numbers under the local state number as well as now institute. So there you want to make it very amply clear, you can add the word ICAI firm registration number. Now we have to talk about CARO. Now CARO 20 is applicable. As we know, not applicable to some companies. Now it is not, CARO is not applicable banking, insurance, section 8 companies, one person company and small company. Now you realize the reason why earlier we worked out whether I am a small company or no. Now, if you have done that exercise and you find that your audit is a small company, now you will be relieved. Arey, wow, wow, wow. Very good, very good. What a great relief. I don't have to go through those 41 clauses of the CARO. Now, new CARO has so many clauses. Huh? So that saves a lot of your time. So 5 minutes spending on that exercise to find out whether a small company or no will save a lot of your time. So that's why I said some of the checklists we must prepare. And as and when we go along, there are exemptions, non-exemptions given. So it will be very handy. Since you have done the working, you know, oh yes, audit is a small company. Okay, conclusion, audit is a small company. CARO 2020 is not applicable. And whatever this criteria, you prepare an Excel sheet, tell your audit staff to put the actual things. For example, there says your turnover should not exceed X. So tell them to write exact number. If your borrowing should not exceed something, tell them to write exact borrowing, so that even if they made some error. So on the one side you say turnover not exceeding, let's say 50 crores, hypothetically I'm saying, and they will write, okay, turnover is 30 crore, 29 lakhs, etc., etc. So you can see, fine. So this clause is not applicable. And then you conclude, oh yes, it is a small company or it is SMC, but don't simply tell them to put yes, no, not applicable. Tell audit staff to write the facts. And then having written the facts, come to the remarks and then come to the conclusion. So that will help you. If any error they do it, you can easily find out. Okay. So again, Caro is not applicable. Caro will be applicable. So even if means it is not applicable to private company, provided you are not a holding subsidiary of a public company. Okay. And your paid up share capital for reserves and surplus is less than 1 crore as on the date of balance sheet. Borrowing from banks financials is not more than 1 crore at any time during the financial year 21-22. Revenue is not more than 10 crores during the financial year. Then Caro is not applicable. Okay, and these are all cumulative. So these are all simple, like banking company, Caro is not applicable. Like. So what happens? Small companies, or after all, it is a company under the Companies Act. Now you have another exemption called private company who fulfills following conditions. Assuming you are a small company under 285, but you are not fulfilling the criteria of private company. Let's say your reserve and surplus is less than 1 crore, but you have, let's say you have 105 lakhs, so more than 1 crore. So being obviously, when you're a small company, you are obviously you could be a private limited company, I'm assuming. And if you're a private company and having a net worth of 1 crore and 5 lakhs, so Caro is applicable. However, if you fall under small company, you fall under the exemption. Are you getting me what I'm saying? If you fall under any one of these, you will fall under exemption. So assuming you don't fall under exemption as a private limited company, that means Caro is applicable. However, you fall under the small company and exemption is available, then exemption from Caro is available to you. Okay, that difference you have to find out. And secondly, Caro reporting is not required for consolidated financial statements. Your audit report which you prepare for CFS, Caro is not applicable. So that exemption is across the board. And small company is exempted even if Caro is applicable as specified for private company. That's what just now I mentioned. I stressed this. Make it very clear that even if you fall under private company and Caro is applicable, however, you continue to be a small company and you have exemption, you will continue to have the exemption. Then IFC is applicable to some of the companies. I mean, first of all, it is exemption. Auditor is not required to report if you are 1% small company or private company with turnover of less than 50 crores and borrowing from banks, financial, etc., less than 25, etc. The exception shall be applicable to private company which has not committed a default in filing its financial statement under 137 or annual return, etc. Otherwise, IFC under 143 subsection 3 clause 1 could be applicable, and then your audit report should contain the matter related to IFC. However, as per the guidance note, we have to remember our IFC reporting is only limited to IFC with reference to preparation of financial statements and not for the whole of the business. Then another important things during the audit is the CSR expenses, because even though we are doing audit of some private limited company, CSR might be applicable. So you must prepare applicability of CSR. You can prepare in fact beforehand. For example, assuming you are in the month of January 2022. So if your staff is free and you have to do audit of 3-4 companies, because the CSR working is based on the last year audited figures. So whenever they are free, we can tell them, please fill up this template whether CSR is applicable or not. If they are free, let them finish off that exercise. Now these are the 3 criteria. If your net worth in the previous, so financial year 2021, if your net worth is 500 crores or more, or turnover is 1000 crore or more, or your net profit is 5 crore or more. Sorry, here there is a little correction. During the immediately preceding financial year, that is, we need to read this as a 21-22. Okay, then 2% of the average net profit is the amount you have to spend on CSR, and then you have to do the disclosure. Okay, so work out whether CSR is applicable or no. If it is not applicable, conclude, prepare that Excel, that module may this criteria, put the figure and conclude that CSR is not applicable for the financial year 21-22. So then there is no further disclosure related to that required. But if you fall, then work out, and then there are further disclosure nowadays for 21-22 as to what was the amount you have to spend, how much you have spent, how much is carry forward from the last year unspent. Last year you were supposed to spend 100 and you have spent only 80. So 20 you have to spend. Now current year, let's say you have to spend 150. So you'll say 150 to be spent. Out of it, let's say you have spent 80. So 70 is still to be spent. 20 rupees is carry forward of the last year. So now your brought forward is 90 rupees you have to spend in the subsequent year. And then CSR has been amended. Now, if you have not done after end of the year within particular time, you have to transfer this to a separate bank account like a dividend. Dividend, when you declare, if you have not distributed within 7 days, you open a separate XYZ company dividend account and you transfer that fund. And as and when you disburse, you have to disburse. That means you cannot use this money for your business. Similar things are applicable in CSR. So if you have not utilized within particular thing, transfer to that. Now dividend, if it is not claimed by the shareholders for 7 years, it goes to investors, education and protection fund, IEPF. Similarly, this CSR money will go to the prime minister. 2-3 funds are remarked after 3 years, or I think 3 years or 5 years, something is there. Thereafter, if remains unspent by you, you have to transfer to that prime minister relief fund and those names. So this money will not remain. First thing is, it will go out of your bank account and will remain in separate bank account. So you can't use this money to finance your business or use your day-to-day activities. Fund has to be demarcated and kept separately, and still not spent. Thereafter also it will go to the government. It will not remain with you. In 17, there was a DPT, etc. My conclusion is, by now all those FDs terms would have expired and would have been repaid. So practically this will not be applicable. But I have just kept it in case somebody has prescribed my this deposit for 10 years and they have to continue to file DPT 3 form, etc. Then we have to look at as an auditor. MSME also, there is requirement once in a year they have to file what are the annual return of the MSMEs. With the different authorities, and if they are, our audit is filing this, then we have to look at them, and it could have some impact on your disclosure. As you know that dues of MSMEs, whether it is paid during the year, if not paid during that 45 days, then what is the interest calculation, outstanding, etc. Those disclosure, it has to be reconciled with this, or you have to modify your disclosure. So you have to have a look at this form if your audit is filing. And this is generally, I have given this slides as to the dividend. No? When declared, if it is interim, then we have to disburse. If it is a proposed dividend, then it falls due after it is approved by the shareholders. Then if within particular time, within 7 days, we have to transfer to a separate bank account and disburse. If we have not done, then after 7 days, we have to put it into separate bank account. And after 7 years, it should go to IEPF. So in a nutshell, this explains, because in Rule 11 says in your auditor's report, you have to mention whether the auditee has complied with the rules related to dividend. So you'll have to do this exercise. Now, this doesn't remain limited to the dividend during the financial year 21-22. Let's say 8 years back also they have declared, and 7 years has already lapsed, but they have not transferred the funds to IEPF. You still will have to report that this month's amount remains to be transferred to IEF, for which 7 years has expired. So your scope of audit will go beyond financial year 21-22 as far as dividend is concerned. That's why it is important to do the working on the dividend. So to find out opening unpaid dividend, if any, 7 years have lapsed or not, etc., etc. And whatever dividend declared, whether it has gone to a separate bank account within 7 days, because in private limited, etc., these lapses can happen. Then in your audit report, you have to mention that it was not transferred. However, subsequently, it means you can add further saying that it has been distributed to the sale order, etc., etc. But this is very, very important, because your reporting requirement has entered your main audit report, like a CARO, where you mention in your main audit report, not even as an and then details you put into the annexure. But in main audit report, you mention this is also the requirement related to dividend you have to mention, and that's why I'm drawing your attention to this. I think it is 5:45. Shall we break for 5 minutes or so? Hello.
Sir, please tell me, sir.
Ah,
Can we break?
can we break for 5 minutes?
Yes, sir. No problem, sir. I'll put up a slide here.
Because
I'll just
having
share
heard
my
for
screen.
almost 1.5 hours, their
Yes, sir.
mind also needs little rest and need a cup of tea or coffee to refresh
Yes,
themselves.
please, sir. Please, please, please. I'll just share my screen. We'll have a break slide now, and we'll resume another 5 or 10 minutes. When you're ready, let me know, sir. We'll resume it. Sir.
I'll be ready in 5 minutes. No problem.
Yes. Sir. You can mute yourself and you can read.
Yes.
So can we start, sir? We can. Sir, can you unmute yourself, sir?
Yeah, now I.
Yes, sir. We'll start.
Friends, we were on the dividend part. So this is a summary of the dividend, and now dividend could be two type, either it is interim or it is a final dividend. And if if it is an interim dividend, it is a board which decides the dividend, and if it is a final dividend, then it needs to be approved by the shareholder at the AGM. And always dividend is declared as a proportion for nominal or face value. So if company has two types of paid up capital, I mean face value, let's say is 10 each, but on some 10 rupees is paid up, on some it is a partly paid up, let's say 5 rupees, then dividend will be in proportion. So if they have declared 2 rupees per share, then partly paid up share will get 1 rupee.
Is there any issue, sir?
Yeah, I'm unable to move the slide.
Just click on the page and then you can start, sir. And click down arrow. Yeah.
Yeah.
Just navigates.
Yeah, it is happened. Yeah. And the second requirement is dividend has to be declared only out of the profit. So you cannot declare dividend out of unrealized profit, and this is a very tricky issue as far as if you follow the Ind AS. I'll come to that little later, but basically dividend has to be declared out of the profit. So it has to be out of the surplus in P&L, which could be a profit for the year or accumulated profit of earlier year. As you know that in our P&L, we have an opening balance of P&L 100 rupees, current year profit 10, then we carry forward 110. So if we want to declare any dividend in this instance, out of 110 you can declare. So you can declare even a 20 rupees, assuming you are eligible for the rest of the things. So even though you have earned a profit of 10, you can declare 20 because we have accumulated profit of 100. So that is the opening balance 100, current year profit after tax added 10 rupees, 110, and then let's dividend declare out of that 20 rupees, that is allowed. But in case, and secondly, if you have a losses, etc., then a brought forward unabsorbed depreciation, etc., needs to be set up first, and then anything left has to be utilized for payment of dividend. So profit generated in the till the quarter end, I mean, this is basically for interim dividend. You can draw a rough balance sheet if you are declaring dividend, let's say in the month of July, interim dividend. You have to draw your accounts up to June, and then if you have a profit in that, then you can declare interim dividend. Now, if the company has incurred losses during the current financial year up to the end of the quarter immediately preceding the date of declaration of dividend, the rate of such dividend shall not be higher than the average of immediately preceding 3 financial years. So the amount of dividend shall be deposited in a separate account with a schedule bank within the 5 days. If it is obvious, it need not get paid immediately. So a separate bank account to be opened and fund needs to be transferred there, and thereafter you issue the checks or NEFT or a DD, whatever that mode of payment is allowed, and then it can be paid out of that for the interim dividend. But money will go out of the control of the company and it will remain in the separate bank account. So as I said, it has to be a profit for the year, accumulated profit of the earlier year, or both of them. And earlier, under the old Companies Act, we had, before declaring dividend, we had something called transfer to general reserve rules. Compulsorily, some percentage was required to be transferred. Now that is gone. So now it is voluntarily. Some companies may transfer something to general reserves or may not transfer anything and yet declare the dividend. Earlier, up to 10% of declaration dividend, nothing was to be transferred. Then 2.5% if your dividend is between 10 and 12.5, 12.5 to 15, 5% minimum. Then 15 to 20, you have to 7.5, and more than 20, 10% of your profit compulsorily was to be transferred to general reserves. And in the earlier law, there was a transfer from general reserve rules. In case of inadequate profit, you can transfer from general reserves to P&L and then declare the dividend, and then rules were there. So transfer to general reserve rule has been done away with in the Companies Act 2013. However, there is a rule for utilization out of the general reserves. So transfer from general reserves to P&L for declaration dividend, that rule is there. So in case of inadequate, the company can, they will have to follow the rule 3 of the company's declaration and payment of dividend. Free reserves will not include any amount representing unrealized gains. That means if you have revalued your assets and the amount is lying in general reserves, etc., so that's not a free reserves. So it cannot be utilized for declaration of dividend. Now this situation is much more tricky for the Ind AS, and particularly for the companies which went into first time adoption, became mandatory for the financial 16-17, and a lot of people have revalued in the previous year. When you have transited from AS to Ind AS and some exemption being given, people did revaluation in the earlier year, it means opening balance sheet, etc. And after 3, 4, 5 years as of today, if you see, unless you go back into the working, then you will not be able to keep a track that out of whatever is amount lying in my OCI, that is other comprehensive income, some reserves. Technically, it will be called reserves and surplus, but it would consist of a major portion of revaluation, because some companies have revalued to the extent of 20-25,000 crore. So the auditor of this company need to break up those, because it has lost the identity. One, it has gone into that common pool of general reserves. After 5 years, 10 years, unless you have kept the track right from the beginning, you will not know that out of this general reserve, how much is unrealized, which is a requirement of the Companies Act. So in that case, it will be very tricky for the auditors of those companies. But anyway, for SME, but under the Companies Act, if you have for XYZ reasons, like you are attached with subsidiary as a subsidiary associate or joint venture of the listed company, so you follow Ind AS, and if there also you have followed some revaluation during the first time adoption, then you need to break up your reserves very crystal clear. So even though in the financial statement it is not separated, but in working it needs to be separated, so that even by error you will not declare dividend out of unrealized profit, because that's a requirement of the law, and there are severe punishments if it is done for the company. But AS following revaluation reserve will remain in revaluation reserve separately, so easy for the auditor to find out. However, it could be little tricky that now that when you do revaluation, your cost of assets has gone up. So your depreciation every year will go up. Let's take an example that you have done revaluation 5 years back. Net WDV at that time was, let's say, 100 rupees, and we have revalued it to 150. So 50 rupees is the revaluation reserve. Now, as per the accounting standards, amount was lying in revaluation reserve. Your cost of asset has gone up by those 50 rupees. Your depreciation, and let's say on a generally, let's say you are charging on a straight line basis. So let's say 2 rupees out of that 50 every year is getting charged to the is getting charged to the PLN because of enhanced depreciation on the revalued amount. So on 50 rupees in last 5 years, 222, so you have already debited 10 rupees to your revaluation reserve. Earlier, to some extent, you were eligible to withdraw from revaluation reserve and transfer to general reserve. Now you can't do all those things. So then in that case, you will have to keep that, because after some years, you will have to remember that all my revaluation reserve has been charged to P&L. No more it has remained strictly out of the revalued portion. Because this extra 2 rupees we have been debiting. So that is now your realized. So let's say in our example, 2 rupees per year. Now 5 years back we have done. So now when you come to 22, 10 rupees we have already charged to P&L. So out of revaluation of 50, 10 rupees is realized. 40 rupees remains unrealized. So if such situation is there, you have to be very tricky, or otherwise on a safer side, don't touch that. You declare dividend only out of the realized. End of whatever 10 years, 15 years or 20 years, when the whole of the revaluation is fully charged to depreciation, then you write back the whole of revaluation, transfer to general reserves, and thereafter you treat that as free reserves available for distribution to dividend. So this accounting standard also plays little tricky part in compliance of the while complying with the Companies Act. So looking at the requirement of Companies Act, we need to have some working for specific situations like this where the revaluation is done. Now, if you want to transfer from general reserves, then there is a rules. You have to declare the dividend at the average of the last 3 years dividend declaration, assuming if you have not declared any dividend, and even if you have you want to declare, otherwise you take the actual amount, and the profit has, I mean, whatever you transfer from general reserves to P&L has to be first utilized for knocking off the unabsorbed depreciation, etc., and only on the balance amount is to be utilized. You can't withdraw more than 10% of the paid up share capital and free reserves as per the audited financial statements. Then the balance after transferring from general reserve, the balance minimum remain should be a 15% of the paid up share capital as appearing in the latest audited financial statement. So these are the restrictions which were earlier also there, now also you have. But transfer before declaring dividend, what you are required to transfer to general reserve, that restriction is totally gone. So this you have to remember if you are declaring dividend by transferring fund from general reserves to P&L. If you are not doing that, nothing to be done. So this slide just summarizes that dividend is payable in cash, means now as per the RBI it has to be compulsory by check, NEFT, or what they call it ECS. And dividend is payable to the registered shareholders or his order or to his banker. So normally in the listed security, if you have ADR, GDR, there could be 100 shareholders under the ADR, but total is X number of shares multiplied by dividend per share. You give it to their banker, and in turn banker will distribute to them. Now, having done all those, now one more, this is very important requirement. If you have not complied with the requirement of section 73 and 74 of the Companies Act, you cannot declare dividend. That dividend either interim or the final. Now 73 and 74 are related to the fixed deposit. These are the rules related to the fixed deposits. Fixed deposit from the public. So if you have defaulted in payment, etc., or you have not complied with the requirement of obtaining the fixed deposits, or under section 73 there is a prohibition on acceptance of deposits from public without complying something. Like you have to file particular form, prospectus type, you are eligible for 15% of your net worth, that, etc., etc. You have to file it, and then you have to solicit the deposit. So if you do not comply with all those rules and you are in default, and 74 is related to repayment of deposits, so you have defaulted in repayment of deposits, etc., then you cannot declare the dividend. So this is very important. So any company declaring dividend, first find out whether they accepted public deposit. If yes, find out they have complied with all. If not, then they cannot declare. And if they have done all these things, your duty is to report in the main audit report. So that's why now all these things are very relevant. Earlier it wasn't. If they have detected, then they will face the music from MCA, etc. But now no, you have to report. and thereafter whatever they face the music, it is very much there. Again, these, if dividend is declared, then 30 days and has to be not paid, then within 7 days it has to go, and how it has to go is just recapture of this and then transfer to IEPF, just for your further clarification. Now another requirement which has come, which you have to report in the main report, is there are two things. Your auditee could have given loans and advances. Let's say you are doing audit of A Private Limited, and A Private Limited has given a loan to XYZ Private Limited, saying that from this you give a loan to PQR Private Limited. So there is a reporting requirement you have to disclose. Notes to accounts also it will come, and here also you have to disclose that as per the information given, there are nothing which has been given and not reported in notes. So there is no debar. One private limited can give a loan to another, and normally in private limited also it is quite possible that you give a loan to your step down subsidiary. Let's say your step down subsidiary is in Singapore, and which is a holding company or holding company for your investment in foreign countries of other subsidiaries. So you give a fund to that subsidiary in Singapore. In turn, Singapore's company will fund US subsidiary or Europe subsidiaries, either in UK, Germany, Netherlands, etc., etc. So normally funds are routed like this. Or you have a subsidiary in Mauritius, and then Mauritius subsidiary further is a holding company of other investment or other your manufacturing or other trading companies in USA, Europe, Africa, Japan, Australia, XYZ countries. So that company, your step down subsidiary, becomes the holding company of various other companies in the world. So obviously, suppose you want to set up a business in USA, and US company's holding company is the one which is the subsidiary of yours. So you have a subsidiary in Mauritius. In turn, that Mauritius company becomes the holding company of a manufacturing company in US. So based on the size of activity, you will fund your Mauritius subsidiary, which in turn will infuse the equity or give a loan. So when you do audit of this Indian company, or rather you have one more company in India, this reporting requirement is two-way. If you are auditor of a company which has given a loan to somebody else, and that somebody else is supposed to invest in some further investment, and if you have not disclosed in notes, then you have to report it here. So your reporting is that way, that company has given advances, loans, etc., with the intention to give it further as disclosed in notes. So nothing has come to our notice whereby company has given a loan and which is not disclosed in notes, that it has to be further loan to somebody else. So that is one reporting requirement. Now second is, you are doing audit of a subsidiary company in India, and you have a holding company in India. So holding company has given a fund to the subsidiary which is in India. You are doing audit of this Indian subsidiary, and you have received advances or loan or money from the holding company with the direction that this money you give it to the subsidiary in US. Then also reporting is required. That is what, and this has come first time in 21-22, and this is mandatory. Either you have, and even if it is done, you have to give a disclosure in notes to accounts. So management has to give a disclosure. So your reporting is that yes, we have received funds. So your reporting will be that you have not aware of anything you have given to somebody with the intention to give a loan to somebody and not reported in notes. So are you getting me? There is no prohibition in doing this. Whatever you have done like this, management is supposed to disclose in notes to account. Now, assuming you have received the fund with a very clear-cut instruction that this money you give it to somebody else, or this money you keep it in deposit, and give a guarantee for a loan given to XYZ unit, maybe your subsidiary, or it could be a third party. And if it is not disclosed in notes to accounts, then it will get reported. So these two reporting comes under clause 1. And clause 2, you have to disclose who is the beneficiary, and if that beneficiary is not as disclosed in notes to accounts, you have to report here. This is the new requirement. So this is applicable to all the audit report, and this is a part of the main report. Like dividend. So now what is the intermediary, etc.? We have to refer to the guidance note on division 1, 2, and 3. Institute has come out with the guidance note. Then directly, indirectly, etc. Guarantee means what? Ultimate, who is the ultimate beneficiary is the company. Then disclosure is to be made for the utilization of the fund. So if you know that this has been ultimately 1, 2, 3, 4, this all has come because of ILFS fraud. So just because of fraud by one company, now this requirement is thrust upon balance 99% of the company. That if eventually it has gone to the ultimate company, how that company has utilized the fund. So when management has disclosed that yes, I have received 100 rupees from the holding company, which I have to fund to another XYZ private limited, fine. Then you have already given to XYZ, you have disclosed also. Then you also further will have to disclose what was the intention. You have given 100 rupees to XYZ. But whether XYZ out of 100 rupees, let's say they utilize only 70, 30 is still lying with them. Then what is the status of that 100 rupees? You have to disclose in notes and also in this report. So in report we will say that yes, unutilized amount has been or this X amount, 100 rupees is given, out of which 70 has been utilized for the purpose for which you have been directed, and 30 unrealized unutilized amount is lying in bank deposit, blah blah blah, etc. So that reporting is there, for which you have to get the information from the management and also from that company. So that is a real challenge as to how do we get, etc. But anyway, if you don't get, don't issue any report. So there are twofold. One is if it is given, how much amount is given and how much is utilized and how much remains unutilized. Secondly, if whatever amount is given to you and not disclosed in notes to account, that also you have to highlight it in your main report, saying that for XYZ company you have received the funds to be financed through ABC and company, and this amount is not disclosed in the notes to accounts by the management. So this is a very big responsibility which has come on us. And the word is directly, indirectly, lend or invest, it could be anything. Guarantee also directly, indirectly. So then particularly for the foreign entities that sometimes they use comfort of letter, or you use your letters of credit or buyer's credit. So whether that can be considered, because these are normal things. You normally use this for your subsidiary also. Like if you have a subsidiary in foreign country, the bankers takes letter of comfort and then only they advance money to your subsidiaries. It's like both are in India, then obviously they know that the ultimate Gangotri is you. You are controlling this company, so they need a comfort letter from you. They intend if your subsidiary or associate is not able to pay. Here need not be subsidiary, it could be associate, it could be supplier, or it could be totally unrelated. He has no business relations with you. So it could be anything, but that reporting will come under your main audit report. So during our audit, we have to go through all the pass-through entities. The longer the chain, longer is our work. And then still it is difficult unless this information comes from them. If it doesn't come, I would urge members that you straight away put a qualification, this information not, we are unable to comment on this, or outcome of this, we are unable to consider the impact of this. So this is very tricky, and in many cases they use chain of the funds. Every time it will not be possible for you to get the corroborative evidence as to what he says has been done or not, because it's totally dependent on the various other entities. If it is your subsidiaries, associates, fine. It could be unrelated party who can refuse to pass on the information to you. So practically, when we come to implement, it will be a very challenging amount. But anyway, in the guidance note, they have given us, kind of notes or kind of the disclosure you should do it in situation 1, situation 2, situation 3. So members can take the clue from that and accordingly prepare the notes to account as well as disclose in the auditor's report. Because in disclosure, you have to give either the PAN number, SIN number. If it is registered in India, you get SIN. If it is outside India, PAN also may not be there. That could be a tax number or something. Different countries might have some different numbers for their taxpayers. Like how we have a PAN, like this, some number could be there in other countries. Some countries may not have anything, so there it could be very difficult. But being registered, some registration number with the like ROC we have, like MCA, some registration number will be there. So we have to disclose that. But challenge is how to get that. If it is a related company like subsidiaries, associate, joint ventures, then easy. But if it is like Cayman Island, it could be very difficult because it shrouds under the mystery. But then we have to make appropriate disclosure that this information is not available, so unable to give this information. Yeah, so I am through with my presentation and I just share with you my own experience. See, because what happens normally, we start audit, particularly if you have small clients, we start only after the March. And in last 3-4 years, I have found that a lot of changes, lot of amendments comes. So how do we keep ourselves track of it? So like that, in the month of April, when we decide, okay, now let us start the audit. One of the client has completed his accounts, let us start the routine, etc. So one team can do that. One thing during the 1 year, what we need to is we should visit our institute website, and a lot of announcements are there. Last 15 to 18 months announcement you go through. Exceptionally, there could be like Caro was applicable for 2021, postponed for 1 more year and like that. So there you have to go back to the 2 years announcement. But such major things are known to us. Rest of the things, go through that, find out which are the relevant amendments which are applicable to our auditors, and let us note down it. Or we can download that and put into one folder. Now I have a habit that every year, that let's say example, now that financial year 22-23 has started. So any amendment which is applicable for the year 22-23, I will create one folder, audit for 22-23, and then further I will have under that some other folders like Ind AS changes, AS changes, Companies Act changes, SEBI changes for the listed companies, and I'll put into that folder. So before starting audit, I'll go through all these folders that to find out what are the new things which has come. Something could be critical, something could be just modification. So before starting anything, I'll go through that so that I don't miss. This is one way of doing it. Secondly, as and when results starts coming, I mean, particularly when you do the audit of the listed companies and you know that you have a quarterly requirement, etc. So you look at some of the good companies, 5-10 good companies you can identify, like Reliance, Infosys, TCS, Birla Group, 2-3 companies like Grasim, Indian Rayon, etc. And 8-10 companies, you study that what disclosure they are doing. Now, the moment you spot that some new disclosure has come, so it should raise your antenna. Some amendment must have come, otherwise this company will not do this presentation. So again, go through various amendment which has come. Being a member of the institute, you get your CA journal. So last 15 months journal you go through from government department. So all the notifications of governments under Companies Act, sales tax, GST, income tax. Then in income tax we have case laws, etc. But fine, in audit we have other requirements. So we can go through and find out what are the changes under the basically Companies Act, Ind AS, etc. And then note down what are the applicable. Because in last 4-5 years I have found a lot of amendments are happening, and assuming there is an amendment in now month of June, by the time next March comes, I would have forgotten what amendment had come. So the best thing is to do like this. And sometimes if after seeing this amendment, you know this is applicable to client A, then create a folder, client A, year ended 31st 23, and that particular amendment straight away put into that. Or you create a Word file, say this XYZ point is applicable, so that when you start and when you do it, you don't miss out on anything. Sometimes now, so for listed companies, you get all soft copies. Otherwise, earlier when you used to get the printed balance sheet annual report, on Saturday, Sunday sitting home, I would flick through, and many times, I mean, I'm telling you my own experience, that I would read a Caro, and in Caro, on some situation, I find a very good wording. The moment I see that wording, I'll write down on a piece of paper, and now that we have a computer in the Word file, and no doubt those requirements have been going on since last 10-20 years. But what the way I was reporting, I find my reporting is little inadequate. This is more appropriate. So I'll write down that, so that from next year I change that reporting. So reporting could be there in Caro, or it could be even in notes to accounts. Because some people really beautiful drafting skill they have, and let us accept if we don't have that skill, but whatever good we see from others, at least let us try to improve ourselves. So this is the way I can, this is the way I keep a track, so that we make the minimum error. And if you visit the FRRB sites or institute sites, they have come out with the publications having gone through various audited or reports of even listed, unlisted, everything they go. And let me share with you, since SIRC members are there, they must be aware that they go through, they review even a tax audit reports. And then they come out with the shortcomings. So whenever periodically these shortcomings report are available freely on that website, download at your leisure, go through that. Now, while going through that, you will realize, I have missed out on this. See, it's not that you are doing intentionally, unintentionally. Like in earlier years, I have seen many accounting standards, notes related to accounting policies, where we say that inventories are valued at cost. Accounting standard doesn't allow you to. It has to be cost or net realizable value. So when you see that good companies are doing, you go back, read the accounting standard. Now, whenever you have any doubt, I would suggest straight away open the accounting standard. There are various paras. We talk about disclosures. So read all those disclosures. So there are, let's say, 3 disclosures. 2 may not be applicable to you, but at least don't read the full standard, but read at the disclosure wherever you have a doubt. So you will never ever miss that this disclosure was applicable to you and you have not disclosed. Because whatever error you do gets caught by this FRRB or our institute, then they have published. So at your leisure, go through that. Even in at WIA also, here we have held seminars where we have discussed that these are the remarks of these FRRB and institutes, this committees which has gone through earlier. Now it's gone through by FRRB, they publish it. So what are the common errors? So if you go through that, then you will try to avoid that. In the process, your financial statement will be, if not 100% compliant, 95, 97, 98% compliant. That is also very good. And another thing you have to remember, I am talking of Part B corporate entity. I have seen some friends calling me, this I have company is very small, nothing, I want to prepare accounts on cash basis. That's why I have put it in bold. If you are a corporate SSE, you cannot follow cash basis. It is mandatory under the Companies Act to follow accrual basis of accounting. And that is mandatory. You don't have a choice. If you are a non-corporate SSEs, yes. Like if you are a proprietary firm, like professionals or SMPs, you may follow cash basis. But if you have converted into private limited doing consultancy and they say we want to follow cash basis, sorry, you can't do. Your auditor will straight away put adverse remark. So these are a few of my observations. And now, if you have any queries, etc., I would just invite you to raise it. We can discuss. Over to SIRC. Can you share the queries with the members?
Selva.
Yes, sir. Hello.
Sir has completed the presentation. Now interaction.
Yep. Yes, we have some questions, sir. We'll take it up, sir. I'll just share my screen, so on, madam. Just in
Yes.
another page. Just share my screen. Okay. Is my screen visible? Sir? 1 minute. It's loading up.
I have to click on that.
No,
Yeah.
sir. No. Now you're able to see that, right? Okay. So there are 5 questions, sir. And, we'll take them from the first. Yeah.
Okay.
So
Now
read
here
others
the
and
yeah. I'll read the query and then accordingly I'll answer also. Now Indian subsidiary does not fall under India's applicability, but the company is a subsidiary of Japanese company and the Japanese holding company is listed on Nikkei stock. Does the Indian company fall under India's? Okay. See, now you are an Indian company. So under the Companies Act, you will have to see whether you follow India's or no. So you have to apply your own net worth, etc. Because what is this applicable is related to the holding and subsidiary companies in India initially. And let me tell you, Japanese company will be following probably IFRS. And if assuming a little digressing that suppose your holding company is not in Japan but in USA, then they have a US GAAP, which is different than IFRS. So your company can continue to prepare your accounts as per the AS if you fall under AS. But because of your net worth of Indian company, if you become India's, like your net worth exceeding 250 crores, then you will have to prepare in India's. And for the purpose of consolidation, either with Japanese company, USA company, Europe company, etc. There are, if they're not following IFRS, even if it is IFRS, there are little carve outs as vis-a-vis India's. And if those carve outs are opted by you, then you have to modify your accounts and make it comparable with those of the Japanese companies, assuming that they are following IFRS. And that modified accounts you will have to submit to your holding company for consolidation, assuming IFRS is applicable in Japan. Similarly, if your holding company is in US and that is as per US GAAP, there could be more differences between Ind AS as well as US GAAP. So you will have to convert Ind AS into the US GAAP, like Infosys. If when they are converting their accounts into the US GAAP, so they pass those entries to convert Ind AS into the US GAAP because they are listed on New York Stock Exchange, etc. So they have to prepare as per the US GAAP. So that gets prepared. But as far as Indian Companies Act MCA is concerned, it is either Ind AS or AS is applicable. I hope that is clear. Whether rotation is applicable to a public company limited by guarantee. See, rotation, I have given those criteria. If you fall in those criteria, rotation is applicable. Otherwise, no. So first remove your conception that this is applicable only to listed company. Even non-listed companies with the criteria, rotation could be applicable. So limited by guarantee, that is something like Section 8 company where you can't distribute. But if it fulfills those criteria, rotation will be applicable. Company has 1.50 crore share capital and 52 crore borrowing. No, as I said there, you have to fulfill both wherever. And in some cases, it is a cumulative. So where if your borrowing is more, but your capital is less than, still you will not be a small company. Whether presence of common director in two companies would come under associate category. See, basically, if you look at the associate company is the one where it says if you hold 20% and more, it is an associate because you are influencing the decision. Now, your influence technically can happen even without holding a single shares. So in that case, yes, it can, but practically nobody takes it as an associate because then those disclose. But what will you associate? Assuming you are holding a 0 share and you are associate, what you will what we will incorporate? Nothing will come in here except initially disclosure. That's why there is my associate company, and share from associate is nil. If it is a subsidiary, it could still make a difference. Assuming you are holding 0 share in the subsidiary company, and assuming the board of director of that company acts as per your advice only, and you are not holding a single share. So holding subsidiary consolidation, how it takes place? The whole of balance sheet gets incorporated, and because you are holding 0 shares, the full net worth, let's say 100 rupees is a net worth, so 100 rupees will go to non-controlling stake. So that can impact your balance sheet as well as P&L. And in the P&L also, you will take the whole income, whole expenses, and let's say your profit is a 20 rupees there, and then we will say share of the non-controlling interest 100 rupees, and nothing gets added to your profit, and nothing impacts your EPS also, because you do not hold any shares, so you are not going to get any benefit out of it. Can final dividend be shown as proposed dividend? No. Now, as you know, there have been amendment in the accounting standard as well as in the Companies Act few years back. Earlier, we used to show proposed dividend even though it was prohibited by the accounting standard. However, now it need not be, and this now it is nothing but the appropriation from the general reserves. Like earlier, we used to have P&L appropriation account below the profit after tax. Now that also has straight away gone into the balance sheet part of general reserves. So proposed dividend will get disclosed in the next financial year. So your opening balance of P&L X amount less proposed dividend, tax on dividend, etc. And then further you add profit of the current year and then gets carry forward.
So those were the questions now, and there might be questions which may come up in our mails, and time permits we can answer. So we'll send it to you over mail, sir.
Or if somebody is raising their hands, we can unmute them and they can ask me also.
I give an option to unmute, sir, and those who are interested participants, dear members, you can unmute yourself and you can raise. Audience, those who want to ask, they can unmute and speak.
Sir, I was the person who, my name is Narsimhan, chartered accountant from Chennai. I was the person who asked the question about the Japanese holding company, sir.
Right, sir.
Sir, I think I was not able to tell the question properly. The company as such, the subsidiary in India, as such, they are not fulfilling any of the conditions required for Ind AS. But,
right.
but it is a subsidiary of another company, which is a listed company. That company is listed not in India, but it is listed. It is not an Indian company. It is a company listed in Japanese stock exchange.
Okay.
My question is, because it is a subsidiary of a listed company, the rule doesn't say listed in India or listed outside India or anything like that. My doubt was, because it is a subsidiary of a listed company, does it come within the India?
No. Subsidiary of listed in India.
Not listed in India. It is listed in Japan.
Correct. Because it is not listed in India, it will not be applicable. I'll just explain you. The consolidation also, these are the requirements. You have to consider only the companies which are incorporated in India. Right. So let's say I am a B Private Limited and I have a subsidiary in India, then I have to compulsorily do the consolidation.
Okay.
Under the MCA. Now I may be a subsidiary of a company in US, Europe or Japan. In that case, if the local laws of Japan requires consolidation, then I have to submit my requirement, my financial statement
in under IFRS.
By following the financial requirement, I mean the financial standards of the holding company in that country. So I might have to convert from Indian GAAP to Japanese GAAP or US GAAP or Europe GAAP, whatever is applicable. So that is called conversion. Now, probably I'll share with you, like now a lot of Indian multinationals are there. Let's take an example of, let's say, Infosys or TCS. They have the subsidiaries all over the world. Now, assuming they are in US, then it is as per the US GAAP. But when they want to consolidate with Indian holding company is in India. Now in India, they are following Ind AS. So those US GAAP needs to be converted into Ind AS and given to the auditor for consolidation. So that is only for limit. So they continue to follow US GAAP. They continue to pay tax in US based on US GAAP. They continue to file their accounts with ROC etc. of local countries based on local GAAP. But for the purpose of consolidation, they need to convert into US. Similarly, let's say if we have a subsidiary of Bosch, which is let's say in Germany, or Bosch in Germany. So Indian company will have to convert into IFRS, give it to them, and they will do the consolidation. But what you are filing with MCA will be your Indian GAAP. So which could be Ind AS or it could be as applicable to you.
Thank you.
So for applicability, you have to see companies in India, either your subsidiaries or holding within India, not outside India.
Thank you, sir.
Is there anyone who want to mute and speak? Sir?
So there is one more question, sir. This rounding off, even for very small companies with 5 lakhs, 10 lakhs turnover, also this rounding off, does it apply, sir?
That's why I raised the flag that remove from our mind that we'll prepare balance sheet in actuals, particularly for corporate entity. That's what I said. This is applicable under the company. See, Schedule 3 is applicable to companies registered under the company. And now rounding up has become mandatory.
Okay.
And obviously, our client will be small, less than 100 crores. So your rounding up has to be in hundreds, thousands, lakhs, or million. And if your turnover is above 100 crores, then you can't even touch hundreds and thousands. It has to be lakhs, millions, or crore. Then you lose another two options. Let's say your private limited company and turnover is 110 crores. Then you can't round it. You can't do the rounding up even in hundreds or even in thousands, because that option is no more there. Compulsory to do it in lakhs, millions, or crore.
The second session वो मैं नॉर्मली नाम absent very common नाम absent
Sir, your voice is cracking. Any question for me? I was not able to hear you properly.
Sir, hello.
Yes, sir.
1 minute, sir. I'm just waiting for. So, is there any other participant who want to unmute and speak? So it seems we are done with the questions, sir. Sir, Pranav, sir, over to you, sir. You need to unmute yourself.
Okay. So it was a very lucid and detailed presentation, sir. And it must have been very useful for our members. Thank you very much for your time and presentation.
I am thankful to SRC for giving this opportunity and sharing my views with my fellow members. And I hope I am of some use to my fellow participants.
Yes.
And I really thank them for a patient hearing. Thank you very much.
Thank you, sir. Thank you very much. All the attendees, thank you very much for making this program a success. And also I thank the chairman for selecting this topic. And
a small request to you, sir, please circulate that technical guide on financial statement of non-corporate entities to all the participants.
Yes,
already done.
And that is very handy and very important, particularly for non-corporated entities. Wherever format you get stuck, refer to that.
Yes.
That's a Bible for you.
Yes, right, sir. Already done by SIRC, sir. Once we'll keep what's called stressing on that, and also we'll try to do exclusive seminars for non-corporate entities only.
There we can get into various details of the exemption, because it runs into 6-7 pages. So I thought I won't be able to cover, and because it is already there in the book and they have a table and everything, so I thought we could share the book directly with them. They can take a print, put it on their table.
We have a plan of doing that one with illustrations and all. and that will reach all the members, it seems. That's what
And
we
it
have
is
thought
a
of.
financial statement also. So
Yes,
you can get a
yes, sir.
guidance.
Yeah, yeah. Thank you very much, sir. I also thank Mr. Selva and back office for the support in conducting this program. Thank you, one and all, and good night.
Thank you, sir.
Wish you all the best. Thank you.